Hi, I'm Ryan, and I hope you're having a great day. No, hey, stop scrolling. Stop scrolling. This is important stuff. So listen, I got a question for you. Is your mortgage insured? And so if the answer to that question is yes, then congratulations, you made a really smart decision. But it leads me to a bit of a follow-up question, which is your mortgage insured through mortgage insurance from your bank? And if the answer to that question is also yes, well, you're in the right spot. Listen up, because this video is for you. When it comes to insuring your mortgage, bank mortgage insurance is a popular option. However, it comes with a few shortcomings. So my mission today is to walk you through a few of those shortcomings and why you might want to consider another option, which is term life insurance to cover your mortgage. Now listen, I know you want to get to the next cutesy cat video as quickly as you can, so I'm going to move fast here. So let's get started. Key issue number one. Bank mortgage insurance insures the principal balance of your mortgage. Now I know, you're thinking to yourself, no kidding, Ryan, that's the point. And it is. Sort of. Okay, let me explain. Here's the issue. The principal balance of your mortgage is constantly declining. Every time you make a payment, some portion of your payment, be it small at the beginning of your mortgage or large near the end of your mortgage, some portion of every payment goes towards paying down the principal balance of your mortgage. Bank mortgage insurance only covers the principal balance of your mortgage. Therefore, the amount of coverage that you have is constantly declining. So here's the part that frustrates me to no end, is the premium, or the amount that you pay in order to purchase the insurance coverage, well, that number doesn't decline. That number stays steady through the life of the policy. So you pay a steady amount every month to purchase a declining amount of coverage. It just doesn't seem like a good deal to me. So let's compare that to term life insurance, designed to cover your mortgage. The amount of the policy will be tied to the initial balance of your mortgage, but it's not tied to the mortgage balance throughout the life of your mortgage. So the amount of insurance that you buy remains constant. The premium remains constant, and the amount of coverage that you have remains constant. It's not declining like it would be with bank mortgage insurance. Okay, you guys still with me? All right, let's move on to key issue number two. Key issue number two is that bank mortgage insurance uses a process called post-claim underwriting. All right, so we're getting into some serious insurance lingo now. Underwriting. Underwriting is the process that an insurance company goes through in order to assess you and your health and your medical background to determine whether or not you're insurable. Bank mortgage insurance doesn't go through that process until after you make a claim. They don't truly assess your insurability until it's too late. So the average bank mortgage insurance application includes about 5 or 6 questions, and as long as you answer no to all of them, well, you're approved. Or are you? You'll start paying premiums right away, but they haven't truly underwritten your policy until you make a claim. That's when they're going to really truly decide whether you're insurable or not. And if they find something they don't like, well, they could deny your claim. And recall, we're talking about life insurance here. So by the time someone's making a claim, it's too late to go back and get the appropriate insurance coverage that you should have got in the first place. Unless, of course, you have a 1982 DeLorean with a flux capacitor in your garage. I think I just dated myself. If you don't know what that is, go Google it. So let's compare this to term life insurance, where the policy is underwritten before the policy is issued. so that when you go to make a claim, you can be confident that they've already assessed your insurability and that your claim will not be denied based on post-claim underwriting. All right, we're moving quick here. Let's move on to key issue number 3. Key issue number 3 is all about flexibility. So in insurance lingo, the beneficiary is the person that you identify as the one who will receive the benefit or the payment in the event of a claim. With bank mortgage insurance, the bank is the beneficiary. You don't get to pick the beneficiary. Bank mortgage insurance provides no flexibility in this respect. The insurance benefit, which of course will only be the remaining balance of the mortgage, gets paid directly to the bank, not a cent more, not a cent less. Bank mortgage insurance is designed to protect the interests of the bank. So let's compare this to term life insurance, where you have the flexibility to pick the beneficiary of the policy. Now, in the context of covering a mortgage, the beneficiary is typically the surviving spouse. Now, the surviving spouse will have the flexibility to use the funds as they see fit, as they wish. Now, typically they're going to pay off the balance of the mortgage, but they could also pay some other critical bills or top up the children's college fund. These are all legitimate ways to use those funds. The point here is that, number one, you get to pick the beneficiary, and number two, they have the flexibility to use those funds as they see fit. Okay, so let's bring this thing full circle with a couple of scenarios. Scenario number 1, you buy mortgage insurance from your bank. You pay a constant premium for a declining benefit that's tied to the principal balance of your mortgage. When you file a claim, you run the risk of the claim being denied due to post-claim underwriting. And if they do pay the claim, well, that benefit goes directly to the bank, leaving your surviving spouse with no flexibility at all. Scenario 2, instead of bank mortgage insurance, you buy term life insurance to cover your mortgage. The policy is underwritten before the policy is issued, therefore that you can be confident that in the event of a claim, the full benefit will be paid. And you get to pick the beneficiary who will be the recipient of the full insurance amount, not a lesser amount tied to the principal balance of your mortgage. That leaves your beneficiary with the flexibility to use that benefit as it is most needed. And you want to know the kicker in all this? These two scenarios cost virtually the same. Term life insurance can cost the same, if not often less, than comparable bank insurance. It's one of those rare instances in life where the better option costs the same or less than the lesser option. So listen, if this video has been helpful for you, then great. Please don't hesitate to leave comments and your thoughts below. If you know someone who this information could be very helpful for, well, please pass it along. So, there you go. Bank mortgage insurance versus term life insurance to cover your mortgage. And now you know.